It's not uncommon to see anywhere between 75 to 150K of equity right away before it's even finished. And so you're probably wondering how that happens or where we get that from. So let's talk about that just for a little bit. I've talked with investors about this over and over again because I've seen it over and over again with my personal investments and then also with investors that we've helped with FIG. If an investor comes in and builds new construction, they're getting in at a much lower purchase price than what it's actually worth. That's what we call the equity play. And how do we factor that in? Well, the easiest way is you take the purchase price on what you're paying for that new construction fourplex, and simply you just look at the comps or the comparables of other fourplexes or similar properties to that one that you're buying and see what they have sold for. That's the best and easiest way. And in Utah, Idaho, Texas, we have those resale comps. Arizona, it's still a little early to where we haven't had a project and we don't have resale comps. And so one of the ways that we can figure out what the equity play is there or what that property is going to be worth is you can work into that backwards. And as what I mean by that is you can take your net operating income, your NOI, your yearly NOI, and then if you divide that by the current or the going cap rate for that market, let's say it's 5%, you take those two numbers, you're going to get what's going to be that market value. So there's a different way to look at this. You can take your comps, or you can work into it backwards by taking and understanding what the going cap rate is and dividing that by the net operating income. A good example of this, of the equity play, is the duplex that I purchased in the Village at Boulders in Harriman. This is around 2018, so about 2 years ago. I purchased through FIG, built new construction, went through the process. Purchase price at that point was around $400K. When it was finished, the market value or the equity play was actually around $500K, maybe even a little bit more. And that was completed, if you remember, it's about a 12-month build period, so about 12 months after. So within that build period, and even sooner, I had about $100,000 of equity within that property. Now recently, I just resold that property for $580,000. That was 2 years later. So I know the market's gone up, but even before then, before it was even finished, there was a good equity play involved. Because I took on that risk, I came in early, I went through the new construction phase through FIG, and that's what we call the equity play.